Make sure to hit that subscribe button and turn on notifications. By subscribing, you'll get access to more videos packed with valuable content on financial intelligence.
Invest in real estate simply for real estate itself. As the years went on and my base of education grew, I came to better understand the bigger picture of the world of investing. Rich Dad said, if you want to be a sophisticated investor, you must see what your eyes cannot see. What my eyes could not see were the legal and tax advantages that real estate investing offers the more informed investor. In other words, there is far more to real estate than dirt, sticks, and bricks. This book, written by Sharon Lechter, my partner, and my co-author of Rich Dad, Poor Dad and the Rich Dad series of books, and Garrett Sutton, one of the Rich Dad advisors, goes into the real reasons why the rich invest in real estate. Real estate advantages will take you into the world of real estate investing that the average investor rarely sees. Today, I make my money from 3 asset classes. They are businesses, real estate, and paper assets. But I hold the bulk of my wealth in real estate. Yet more than storing my wealth in real estate, I am able to magnify my wealth using the advantages that real estate offers the sophisticated investor. Like all asset classes, real estate has its trends. As we record this audiobook, there is much talk about the real estate bubble bursting. Many people are afraid of such a burst. Sophisticated real estate investors and I can't wait for it to happen. For this is when we can swoop into the market and ride the next wave back up. If you learn the ins and outs of real estate investing, you can make money in real estate whether the market is going up, down, or sideways. That is why my Rich Dad preferred investing for cash flow instead of capital gains. As long as your property is cash flow positive, you can ride out a downturn in the real estate market. The flippers and capital gains buyers who are left holding properties for resale in a plummeting market are the ones who will be hurt the most. You also need to surround yourself with good advisors. As a real estate investor, you must seek tax advice from a tax accountant and legal advice from an attorney, which is why both Sharon and Garrett wrote this book. I do not know the details of the tax and legal advantages they describe, but I make sure my tax and legal advisors do. If you are ready to become a sophisticated investor and find out how to use tax, legal, and other little-known advantages that investing in real estate offers, and how to find your own team of advisors, this audiobook is for you.
Hello, this is Sharon Lechter. Why 2 authors? As Rich Dad said, it's not what you know, it's who you know that is really important to your financial success. In all of our Rich Dad books, Robert and I stress the importance of having good advisors. Our success at the Rich Dad Company has been in large part due to the advisors Robert, Kim, and I have surrounded ourselves with and consulted with as the company has grown. Our Rich Dad's Advisor series of books are written by those very same advisors. We have many people asking us to publish their books as part of the Advisor series, but we have continued to publish books written by only those advisors who have truly advised us along the way. Real Estate Advantages reveals the tax and legal strategies used by successful real estate investors. These strategies are available to anyone who wants to start investing in real estate. Since we have included both tax and legal strategies in the book, it was important to have the right authors to explain each of these strategies. As Garrett and I have said from stage many times, you don't want an accountant to advise you on legal issues, and you don't want an attorney to advise you on tax and accounting issues. For this reason, both Garrett and I have contributed to Real Estate Advantages. Many accountants may advise you to operate your real estate investments as a sole proprietorship. When you tell them you have read in Rich Dad books that you need asset protection by setting up the right corporate structure, they may disagree and tell you that all you need is additional insurance. What should you do? Find a different accountant. Many lawyers have begun tax services as another way to bring revenue into their firms. Unless they have tax specialists and CPAs on their staff, you may not want to use these services. Let the lawyers create your asset protection strategy through the use of the appropriate entities for your investments and for where you live. And let the accountants create the best strategy for utilizing all elements of the tax law to your advantage. Garrett has advised thousands of people in asset protection and entity selection. His advice in this book could at the least save you thousands of dollars, or in the extreme, prevent you from losing everything due to improper planning.
Offers significant advantages if you do own real estate. Absolutely. But aren't there risks that limit the benefits of owning real estate? Perhaps. Have the rich figured out ways to minimize that risk to their advantage? Of course, and so can you. Real estate offers huge financial advantages to those who will learn the system, and as this audiobook will illustrate, any risk can be efficiently managed through insurance, legal structures, and other strategies that are neither difficult nor expensive. There are great advantages to investing in real estate, both as a money-making business and as a wealth builder. And the financial benefits flow from several sources, including the appreciation of your land and property values, and the monthly cash flow you can earn by renting out residential, office, or commercial space in a structure on your land. In addition, you stand to benefit greatly through tax reduction from depreciation on those structures and through options to roll over profits, as allowed in the tax code. You can even benefit from writing off business expenses associated with your investment. And because of these advantages, it is easier to raise capital for real estate ventures. Real estate investors can accelerate their wealth building much faster than with other assets, such as stocks, bonds, and tax-deferred retirement funds. Our financial, tax, and legal systems are set up to reward property owners who are educated enough to seize the available advantages. And best of all for starting investors, they don't need an enormous cash reserve to buy real estate. They can start small. Like first-time home buyers, real estate investors can secure bank loans and make monthly payments as owners of rental property. And as they watch their equity grow, they can parlay their initial investment property's increased value into garnering a new loan to purchase a second property. Pulling this cash out has a second benefit in that they do not have to pay taxes on the money they receive because it is from their equity. The benefits from real estate are many. The point of this audiobook isn't to encourage readers to invest only in real estate. The Rich Dad philosophy is to put your savings and earnings into 3 different areas: businesses, real estate, and paper assets. This is because each sector is subject to market fluctuations and corrections, and your investment risk must be spread out. This audiobook will explain the financial, tax, and legal advantages of investing in real estate as a passive income earner and to encourage you to utilize these investment advantages. Sharon and I did not enjoy previous careers as real estate professionals, but we have practiced the principles in this audiobook and reaped the rewards. So can you. You may remember the cash flow quadrant from the second book in the Rich Dad series, Rich Dad's Cash Flow Quadrant, Rich Dad's Guide to Financial Freedom. The E-S on the left side of the quadrant stands for employees and self-employed. These 2 types of income earners manage personal finances the way almost all of us have been trained to do so by our parents and society in general. To forge a career in an income-producing occupation and to plow paycheck savings into 1, paying off bills, loans, and mortgages, 2, buying a home, and 3, investing in stocks, bonds, and retirement funds. If you're like most people, you remain on the left side of the quadrant. Other people's money isn't working for you. Your goal is to move to the right side of the quadrant. B-I stands for business owners and investors. These income earners have their money working for them. Their assets are diversified among businesses, real estate, and paper, that being stocks and bonds. The businesses and properties in these investors' portfolios are generating passive income, meaning that other people's money, time, and energy are working for these investors, as is their own money. Robert Kiyosaki's Rich Dad's formula for getting wealthy was to start a business, use the cash flow from that business, primarily after-tax monies, to invest in real estate, and hold that wealth in real estate and paper assets, where it will increase. For those of you who don't know, Robert's rich dad was the father of Robert's best friend and became Robert's financial mentor and a very rich man. Robert's father, poor dad, was a salary earner who believed in education and company or government pensions and invested only in long-term, low-appreciating paper assets. He died poor. Accelerators are the different methods by which you can accelerate your wealth within each asset class. OPM is other people's money. That is, money from lenders, such as banks or investment partners. OPM, $1 to $9, refers to a real estate investor's ability to borrow from a bank or other lender 9/10 of the cost of an investment, while using the investor's own money to cover the remaining 1/10. An example of leveraging good debt. Let's consider an example of how the OPM $1 to $9 accelerator can increase the velocity of your money far more than two other common investment strategies. Suppose you have $20,000 to invest. Here are three choices. Choice 1. Invest $20,000 in a mutual fund that earns 5% a year. After 7 years, your $20,000 should have grown to $28,142, assuming no market fluctuations. Choice 2. Invest $20,000 and borrow $180,000 from the bank for a $200,000 rental property and let your equity compound. Assume rental income only breaks even with expenses and the property appreciates at a rate of 5% a year. After 7 years, the property will be worth $281,000, and your equity, the $281,000 minus what you still owe the bank, is $101,420, assuming no market fluctuations. Choice 3. Invest $20,000 and borrow $180,000 from the bank for a $200,000 rental property. Rather than letting the equity compound, you borrow out the appreciation every 2 years and invest it in a new property at 10% down. After 7 years, your 4 properties will be worth $2,022,218, and your net equity will be $273,198, assuming no market fluctuations. Choices 1 and 2 are examples of parking your money. Choice 3 is an example of increasing the velocity of your money. It allows you to expand your money supply to increase your earning power. Like a bank or other financial institution, you can make your money move. The more times a dollar moves, being reinvested in a new money-making property, the greater the money supply you tap, since the dollar leverages other dollars, and the greater that dollar's earning power. Of course, the ability to work this magic doesn't come at once. It requires an initial investment in your financial education. That education can begin by listening to this audiobook. When you invest in real estate, you are pursuing 2 different goals. One goal is that the value of your property will appreciate over time above the price you paid for it, so you'll be able to sell it for more than you bought it. This is capital gains investing. The other goal is that your property will generate a positive income for you every month. You're aiming for the revenue from rental income to exceed the operating costs and mortgage payment. This is cash flow investing. Having your money generating passive income for you, income that comes to you whether you get out of bed in the morning or not, is a rich dad investment principle. The key with earning a capital gain is to hold on to a property for a minimum of 1 year. This is because you'll get a capital gains tax rate. At this recording, 15% at the federal level for the United States, which is lower than the rate on ordinary income. Some investors pursue a strategy of flipping properties, buying low and selling high as soon as possible, often without holding a property for at least a year. These fix and flippers get hit with the higher tax rate. That defeats the purpose of banking on a capital gain. Let's review a case that illustrates this principle. Tony and Terry had once dated, but found it was easier and less complicated to simply be friends. Their friendship was strengthened by their mutual interest in investing in real estate. But as they had found in their prior relationship, each had their own way of doing things. Tony was impatient. He liked turning his assets over as quickly as possible. But by flipping properties every few months, he was subject to short-term capital gains at his ordinary income rate. Of greater consequence, by doing these turns on a regular basis, it became his trade or business. A salary was properly paid along with payroll taxes. He paid a 35% ordinary income tax, payroll taxes of 15.3% on the first $90,000 or so of income, and state taxes on top of that. Over 50% of Tony's short-term profits were eaten up in taxes. Terry, on the other hand, held on to a property for a year or longer. As such, she enjoyed the benefit of a 15% capital gains tax when she sold the property. So, for example, on a $100,000 gain, she paid a long-term rate of only $15,000, whereas Tony had to pay over $50,000 on the same but faster gain. Both Tony and Terry liked the idea of trading up for a better property, but Tony, due to his accelerated activities, wasn't allowed to do so on a tax-free basis. By being patient and holding on for over a year, Terry was able to use a 1031 transaction, discussed more fully later. She could trade up tax-free for a newer and better property every year or so. All in all, Terry greatly appreciated the slow satisfaction of real estate wealth building. Like Terry, the Rich Dad philosophy is to keep a property as long as its value continues to appreciate and its cash flow is sufficient to at least cover the costs of owning the property. Everyone has a different style and agenda, but it bears remembering that when renters cover your mortgage payment and operating costs, they're in effect paying you to have your equity grow. And financial institutions are eager to lend money to investors who can prove themselves good risks by generating cash flow from the properties in which they invest. This allows the knowledgeable investor to accelerate income with the OPM $1 to $9 accelerator. As a knowledgeable investor, you can put your money to work to build wealth fairly quickly. Time is our most precious resource. For you as a real estate investor, time is an ally. Now it's time for you to put together your plan on investing in real estate. If you're starting out, begin by getting a complete picture of your current financial standing. Not nearly enough investors take this initial, crucial step. To assemble your financial report card, start with the income statement part of your financial statement. This lists your income and expenses on a monthly basis. If you're like most adults in our society, you're living out of your checkbook. Each month, it's money in, money out. And hopefully at the end of the month, you have enough money to pay all of your bills. When you determine your income statement, you'll see what your financial activity is each month. After you've produced your income statement, you need to put together your balance sheet. This lists your assets and liabilities. Assets usually include your investments, such as savings accounts, stocks, 401k plans, mutual funds, real estate investments, and any businesses you own. Liabilities usually include the balance left on your mortgage, the balance left on your car payments, and your credit card debt. There are a couple of tools available at richdad.com that may help you produce your financial statement and balance sheet. One is a personal financial calculator sheet you can download for free to determine your financial statement and balance sheet. Another tool is the Cash Flow 101 board game, which you can order online. Your financial statements will help you set goals. You may recognize that your debt is too high and you need to start paying it down. You may identify areas you want to bolster in your asset column. Cutting expenses and liabilities is one tack. Another is boosting your income. Unless you're able to increase your earned income through working more hours or securing a pay raise or a higher paying job, you'll need to increase your passive or portfolio income. Passive income is almost always the quickest source of increasing wealth. And again, it's the method advised by Rich Dad. Your financial report card will tell you what % of your income is currently passive income. If you're like most people, the answer is 0. When you set your goal for making passive income, you will decide what a reasonable figure for the monthly passive income will be. $1,000, $5,000, $10,000, $100,000. When setting a goal to buy that first cash-generating property, you must also decide what type of real estate interests you. Here are some of the many options: single-family homes, condominiums, duplexes, fourplexes, trailer parks, motels, hotels, apartments, storage units, commercial office space, commercial industrial space, storefront retail space. Within each of these categories is a wide range of possibilities. Small apartment complexes, complexes with 100 units or more, starter market family homes, homes in gated communities, strip mall retail space, high-rise office buildings, and so on. Within this range of possibilities are geographic distinctions. Properties in your city or another, in your county or another, rural, suburban, inner city, waterfront, and so on. What's more, there are very different strategies. Foreclosures, a way to buy properties cheaply without the intention of earning cash flow from them. Fix and flip, also a way to buy cheaply with the intent of selling quickly for a profit. Buy and hold, meant to earn appreciation. Buy, hold, and rent, also meant to earn appreciation, but also to earn cash flow. This is Rich Dad's strategy. It is often best to master one process. To become an expert, say, in buying, holding, and renting single-family residences in middle-class neighborhoods in your city. As you learn the process of investing in real estate in a certain sector of the market, it becomes easier. You get better at it all the time. Let's look at an example of this. Omar was itching to get into real estate. He had read 10 books and had bought one $5,000 system from a get-rich-quick real estate promoter who he later learned had never actually owned real estate. Recovering from that lesson, Omar had talked to over a dozen real estate brokers in his area. Omar had come to appreciate that real estate was not a get-rich-quick enterprise, but rather a slow process of growth and incremental success. Still, he was impatient to begin the process. He had saved $20,000, and it was definitely not appreciating in his savings account, which paid a measly 1% annual return. Omar was intrigued when Ashley was introduced to him by a local broker. Ashley was an attractive woman in her early 40s who had put together a number of real estate syndications. Her typical deal was for 5 to 10 investors to put up $20,000 to $50,000 towards the purchase of a large apartment complex. Ashley received a commission on the purchase of the real estate, a monthly management fee, and 20% of the equity in the deal. When all the numbers were added up, Ashley was quite well compensated. But many of her investors didn't have the time or inclination to be actively involved and were willing to pay for her assistance. Omar was intrigued by Ashley's proposal. He could put his $20,000 into her investment and perhaps in 5 years he could receive $35,000 to $40,000. At least that's what the projection said. Omar was seriously considering the investment until he spoke to Zook, another real estate broker who had taken an interest in Omar and his investment path. Zook questioned whether Omar really wanted to be a limited partner in a real estate syndication. In the syndication, as a limited partner, Omar would have no voice in the project. He would be a passive investor instead of an active and involved real estate entrepreneur. Omar appreciated Zook's comments. He refocused on his goals, which were to learn about real estate by starting small and then grow into larger properties as his experience and confidence expanded. He realized it was possible that a few mistakes might be made on his first investments and acknowledged that he would prefer to make them early on smaller properties where the consequences would not be so dramatic. Omar politely declined Ashley's opportunity to invest. He explained to her that as a passive investor, he couldn't learn real estate the way he wanted to learn it. Instead, Zook found Omar a $100,000 duplex to buy with $15,000 down. Omar's remaining $5,000 was held in a reserve account in the event of any emergencies or vacancies. Omar used this first opportunity to learn about what it took to manage real estate and to increase its value. This knowledge was extremely useful when Omar bought his next duplex, a fourplex, and eventually larger properties. And here is why it gets easier for Omar and other investors like him. A system becomes a blueprint for investing. The chances for making mistakes decreases as experience increases. There's yet another plus of repeating a successful formula. Once you get established in an area of investing, after you've become known as someone who buys a certain type of property, you gain momentum. Brokers will seek you out when good deals arise. A final point about sticking to the same game plan when investing in real estate. When you assemble your team of advisors, your real estate agent will be an expert in the sector you're investing in, but most likely will not be an expert in other sectors. For example, your agent may be used to handling duplexes, but not strip malls. It's best to find your team, understand what it's good at, and use it as your investment vehicle. Now let's talk about creating your team of advisors. Every investor will need advisors specific to his or her investment project. Let's say, for example, you want to invest in single-family fixer-uppers. People who are already investing in them are the ones you'll gravitate toward. One way to speed the formation of your team is to find a mentor who is successful in the investing you want to do. Ask this person for referrals of whom this person uses for loans, appraisals, accounting, and so on. Another way is to get on the Rich Dad forums at richdad.com, announce your geographic area, and say you're looking for advisors in that area. Put together your list of potential advisors and begin interviewing these people. When you approach a potential professional you're considering for your team, ask about the person's experience in the field, whether the person is taking on new business, if you're the sort of client the person is interested in, if the person has clients investing in the kind of projects you have in mind, and whether the person would invest in those projects himself or herself. Ask the person's policy on getting back to you. Does it typically take 24 or 48 hours to return a phone call? Will the person handle your account or pass it on to a colleague or junior in the office? If so, does the junior have experience? What's the billing practice? Charging per hour or per transaction? Also ask for client references. Then call those clients and ask if they're happy with the professional. Once you do put someone on your team, you can anticipate nurturing a long-term relationship. This is especially true of real estate attorneys, accountants, and lenders. They are intimately familiar with your personal situation, and therefore you want them to be invested in your benefit. The better you do, the more business you bring them. There must be a high level of trust. there must be mutual respect. Here is a typical list of advisors and associates on your investment team. Real estate brokers. These realtors or other agents know the market, recognize trends, have access to key information, can tip you off to deals, and can help you make deals. They are your eyes and ears to the market. Other real estate investors. Like agents, other real estate investors can tip you off to deals or bring you into deals. Real estate lenders. These professionals may be at banks or other lending institutions, or they may be private individuals. When you're first starting out, the benefit of finding a lender is to help you know what you're qualified to invest in. Hopefully, this lender will be prepared to support you in your purchase. But when you're actually ready to proceed, get quotes from several lenders and find out who is best for you in the market at this point in time. Other advisors include an escrow officer, an appraiser, a home inspector. You will certainly want to consider a real estate attorney. This lawyer must be a specialist in real estate, practice in your legal jurisdiction, and be experienced in your specific type of real estate. Bookkeeper. There are differences among bookkeepers, real estate accountants, and tax accountants. Bookkeepers typically cost less per hour than accountants. They keep your day-to-day records orderly and up to date. A real estate accountant. This professional analyzes the records your bookkeeper prepares and manages and makes sure your financial statements are correct. A tax accountant. This professional, usually a certified public accountant, helps you strategize your spending with an eye towards minimizing your taxes. The tax accountant also lets you know what you should be doing today to plan for the future. Another role for the tax accountant: to represent you in the event of an IRS audit. In fact, you are wise not to show up yourself at the audit meeting unless you're required to, since you may volunteer more information than needed and hurt your case. The accountant understands what the IRS is looking for and typically can resolve the issues more quickly and efficiently. An insurance agent. You'll need insurance on your property to cover property risk and liability risk. A property manager. When you first start out with a rental property, you'll likely manage it yourself. But as your investments grow in size and quantity, a property manager could well be a wise investment to save you time and energy. As you advance through the world of real estate investing, your advisors will change. You may need a larger mortgage company. If you become the biggest client an attorney or an accountant has, you may want to find the next level of advisor to draw on even greater knowledge. For an advisor at a higher level will have larger clients and therefore will have developed knowledge on larger projects. You'll be paying for that knowledge base. Now, let's take action. In this section, we'll review the tax strategies used by sophisticated real estate investors. We do not expect you to become your own tax accountant or to become an expert, but hopefully you will have new questions to ask of your tax accountant and/or CPA that can accelerate your wealth through the application of these tax strategies. When you're looking at a real estate property, the financial information given to you by the current owner and the real estate agent is called the pro forma. In Latin, the term means as if. For real estate cynics, it means as if you expect me to believe those numbers? The pro forma contains the property's sales price and operating costs, such as utilities and taxes, insurance, repairs, and business expenses, and it projects the property's value and income based on market factors such as a full occupancy rate. As our cynic comment illustrates, the pro forma may not reflect the reality of the property's worth and income potential. Instead, it may only represent what the seller and the seller's real estate agent think is needed to justify the asking price. Use the pro forma as a skeptical starting point to decide whether you're interested in even considering buying the property. If you sign a contract to buy the property, you'll include a purchase contingency allowing you to obtain actual financial figures, commonly called the financials, on the property. The contingency will read something like this: "This offer shall be contingent upon buyer's complete review and acceptance of the financial records associated with the subject property." If it's a rental property, you'll take a close look at what the rental income is. You'll also review rental prices at comparable properties, otherwise known as comps, in the neighborhood to make sure the pro forma figures are in the ballpark. You'll examine the property's operating expenses for utilities, property tax, and the like by asking the seller to show you the actual bills from the utility company and the tax collector. You'll determine what extra expenses you may incur, especially when you have your building inspector examine the place as part of your due diligence. For example, if the roof looks like it may need replacing, how much should you set aside? In this way, you'll know if you need to ask the seller for a price allowance or a haircut, both of which mean a dollar reduction, to make the deal a go. You also must consider what your actual debt service, the principal and interest payments, will be on the loan you obtain. And you must consider how much of a cushion you'll need if the property is vacant of renters for a significant period of time. You'll figure out, separate and apart from the seller's pro forma, if the property will yield a positive cash flow, bringing net monthly income after deducting the operating expenses and debt service. And you'll decide how risky the investment really is. If the property seems a good investment risk and one that will yield a positive cash flow, you must next analyze the property's impact on your overall financial situation. Let's take a look at the purchase of a 5-unit apartment building for $450,000 with 20% down. The IRS considers your rental property as a business and gives you several deductions. One is the payments you make on the interest, but not on the principal, of your debt service. In addition, there are phantom deductions, the passive loss from component depreciation and from building depreciation, which are computed at an annual rate, which is discussed later. So after you take your rental income, 5 units at $900 each per month, or $54,000 per year, and subtract operating expenses of $19,459, you also subtract the interest payments of $15,888 on debt service, and you subtract the component and building depreciation, $15,000 and $10,909, respectively. You multiply this paper loss of $7,256 by your 35% tax rate and determine a tax savings of $2,540. You add the $2,540 tax savings to your net cash flow from the property before taxes, in this case $7,200, and come up with your true cash-on-cash return of $9,740. Your true cash-on-cash return will show you how good, or not so good, a particular real estate investment will be for you. In this case, the $90,000 investment yielded a cash-on-cash return of nearly 11%. Obviously, real estate enjoys a distinct tax advantage over the stock market. If your projected paper loss in a rental property is $7,256, you can claim $2,540 in tax savings. But if you lost the same $7,256 in the stock market, you would only be able to claim the maximum for a capital loss, $3,000, on your annual tax return. To claim the entire loss would take you 3 years. The big advantage of passive income from real estate over portfolio income from stock, and especially over earned income from your job, which the IRS taxes at the highest tax rate of the three types of income, is that the income from real estate can come to you tax-free due to write-offs for depreciation. In our example, the $7,200 in positive cash flow was not taxed. The depreciation wiped out that profit on paper. Determining what your depreciation will be on a property is a crucial step in assessing a property's benefit to you and deciding whether to invest in the property. In a real estate investment, there are four types of property: land, land improvements, personal property, and the structure or buildings, which should be further broken down into the structure and its component parts. The value of the land cannot be depreciated. Assets included in land improvements, such as sidewalks, and personal property, have relatively short useful lives and thus are subject to accelerated depreciation methods. A tremendous tax savings can be achieved through dividing the dollar amount attributed to the building into the components and the structure itself. The tax law allows you to depreciate the components of the building, for example, wall and floor tiles, certain lighting, certain partitions, and certain electrical systems. It is recommended that you have a cost segregation study performed by an independent party to determine what portion of your building can be categorized as components. Your CPA or tax accountant should be able to recommend a company qualified to perform this study for you. Investing in rental real estate offers a wonderful safety net to offset your income from non-passive sources, such as wages or dividends, on your tax return. If your adjusted gross income is under $100,000, you can offset up to $25,000 of your ordinary income from losses in real estate, which would be passive losses since real estate gives you passive income. This is true for both single taxpayers and married individuals who file jointly. In order to take up to the $25,000 deduction, you, or you and your spouse if you file a joint return, must have actively participated in the passive rental real estate activity. For example, you may be treated as actively participating if you make management decisions such as approving new tenants, deciding on rental terms, approving expenditures, and the like. So be careful. If you have a property management company taking care of your rental, be sure that you are still involved at some level. There are some exceptions to the $25,000 deduction. If you are married, filing a separate return, and have lived apart from your spouse for the entire tax year, your special allowance cannot be more than $12,500. If you lived with your spouse at any time during the year and are filing a separate return, you cannot use the deduction at all. Another important exception to the rule relates directly to your income level. The full $25,000 offset is only available to individuals or to couples filing jointly whose income does not exceed $100,000. Once your income exceeds $100,000, the deduction begins to be phased out, and at $150,000, it is lost altogether. So if your income is over $150,000, you can't use passive losses from real estate to offset ordinary income. How then can you enjoy the full benefit of passive losses? By listening to the next section. Here's a case that illustrates the benefits of the 1031 exchange. Blake was an auto mechanic who knew that the way to wealth was through real estate investing. As an auto mechanic, he could only get paid when he repaired a rabbit or tuned a T-bird. If he wasn't working, he wasn't getting paid. But by owning real estate, by collecting rents from tenants, he got paid whether he showed up to work or not. And knowing this, Blake set out to acquire real estate according to the most tax-efficient means possible. Blake had acquired 2 properties in the last 4 years. One was a 2-story, tan-colored fourplex in a strong rental neighborhood. Blake had used deferred maintenance issues, the need for a new roof and air conditioning units, to obtain a below-market price for the property. The fourplex, even after the improvements were made, provided Blake with positive cash flow each month. His second property was a duplex in a transitional neighborhood. Blake had hoped the area would improve at a faster rate and that the tenant mix would improve as well, but this was not happening quickly enough for Blake. So Blake decided to sell the duplex and acquire another property in an area with greater appreciation potential. He was concerned about having to pay taxes on the tidy gain from the sale of the duplex, so he met with his CPA to better understand his tax situation. The CPA was glad Blake had come to see him. By doing so, he was able to let Blake in on an incredible tax strategy that would save him $7,500. Blake was intrigued and asked for more information. The CPA explained that by selling his old property using a 1031 exchange, Blake could defer taxes if he reinvested all the proceeds from the old property into a new property. Blake liked the sound of this strategy and, following his CPA's advice, engaged in the following. First, Blake sold the duplex for $100,000. With just $7,500 down, he had only paid $50,000 for it 4 years ago. So with the sale, he had a nice profit of $50,000 on it. Because he had held it for over 1 year, the capital gains tax at this recording was 15%, or $7,500 on a $50,000 gain. Blake's property and residence were in a state that didn't have a state capital gains tax, so all he had to deal with was the federal capital gains tax. The CPA noted that if Blake moved to or held property in a state with a capital gains tax, he would have to factor that state tax in as well. But the point of the transaction was to defer capital gains taxes until a later day. The CPA instructed Blake to line up a qualified intermediary to handle the monies received from the escrow closing. Blake couldn't touch the money, or the 1031 transaction would fail. The money had to go straight to a qualified intermediary. The CPA then indicated that Blake had 45 days to identify a new property and 180 days to close on it. So Blake set about to promptly locate a new property. After 2 weeks of searching, Blake found a fiveplex in an appreciating area for $300,000. With the $50,000 held by the qualified intermediary and new financing of $250,000, Blake purchased the fiveplex. The $7,500 in capital gains he would have had to pay the IRS in a traditional sale situation was deferred and could be used tax-free to buy a bigger property. Blake liked this real estate strategy. He learned that he could continue to trade up to bigger properties as long as each one was held for a year and a day. Over the next 5 years, Blake traded up 3 more times. At the end of this run, he owned an immaculate 24-unit apartment building, as well as the original 2-story tan-colored fourplex. Both properties were cash flowing, giving Blake hope that someday soon he could retire from the auto mechanic business with a nice continuing income stream. And Blake had to pinch himself when he thought about the benefits of 1031 transactions. For he had started out buying a duplex for just $7,500 down, and without putting in any more money along the way or paying taxes on any gains, he now owned a cash-flowing 24-unit apartment building for essentially $7,500. What a great country. To understand the 1031 process is to understand 6 key rules. To explain these rules, we are pleased to include a section written by 1031 exchange expert Gary Gorman, the author of Exchanging Up: How to Build a Real Estate Empire Without Paying Taxes Using 1031 Exchanges. Rule number 1. It must be an investment property. A 1031 exchange is available only for property held for investment or used in a trade or business. A 1031 exchange does not apply to your personal residence. Under the law that has been in effect since 1991, You can exchange any type of investment property for any other type of investment property. For example, if you sell a purple duplex, you could buy an office building, an apartment building, a warehouse, or even bare land. Or you could sell bare land and buy income-producing property in order to increase cash flow, which is a popular investment strategy. Section 1031 does not allow you to do an exchange on property you hold for resale, although the IRS does not define that term. Essentially, it means property that you buy with the intent of immediately selling rather than holding for investment. A classic example of property held for resale is fix and flips. Fix and flips do not qualify for 1031 benefits. The tax court opinions typically require a 2-year tax holding period. This creates a problem because January 1 of year 1 to January 1 of year 2 is 2 tax years. So is July 1 of year 1 to January 1 of year 2, as is December 1 of year 1 to January 1 of year 2. So the IRS seems to favor a year and a day test, meaning that a year and a day from any point in time will get you to the new tax year. Vacation homes, do they qualify for 1031 exchanges or not? In fact, the IRS says they do qualify. In a 1981 private ruling, a taxpayer asked if they could do an exchange on a vacation home that they bought primarily for personal enjoyment, but also partially as an investment. They wanted to buy a larger vacation home that they would also hold primarily for personal enjoyment, but also partially as an investment. The IRS ruled that they could do an exchange from one to the other, provided that they could prove their investment intent. This can be as simple as sending a letter to your attorney and CPA that says that you intend to own the property as an investment with the expectation of appreciation. It is best to do this when you buy the property, but if you already own vacation property and haven't done this, consider doing it as soon as possible. It would be best if you did this more than a year and a day before you plan to sell the property. Rule number 2. The 45-day identification period. From the day you close the sale of your old property, you have exactly 45 days to make a list of properties you may want to buy. You typically want 3 properties or less on the list. If you put more than 3 properties on your list, you become subject to the 200% rule of Section 1031, which says that, since your list is more than 3, the total combined purchase price of everything on the list cannot be more than twice the selling price of your old property. Rule number 3. The 180-day reinvestment period. From the day you close the sale of your old property, you have exactly 180 days in which to buy your replacement property, and whatever you buy has to be on the 45-day list. Title to the new property has to be in your name before midnight of the 180th day. Rule number 4. The qualified intermediary requirement. You cannot touch the money in between the sale of your old property and the purchase of your new property. The money has to be held by an independent third party called a qualified intermediary. Intermediaries prepare the exchange documents that are required by Section 1031, and they hold the money during the exchange. The law excludes certain people from being an intermediary. People like your own personal or business attorney, your CPA, or anyone that is related to you. But virtually anyone can be an intermediary. So make sure you know who you are dealing with. Rule number 5. Title requirements. In simple terms, how you held title to the old property is how you have to take title to your new property. This means that you have to stay within the same tax return, the same tax identification number or Social Security number. In other words, if Fred and Sue Jones hold title to their purple duplex, they cannot take title to the new property in the name of Jones Investment Corporation because the corporation files a different tax return. Rule number 6. the reinvestment rules. In order to pay no tax, you must do two things. First, you must buy equal or up. If Fred and Sue sell their purple duplex for $100,000, they must buy their new property for at least $100,000 in order to owe no tax. If they buy down and only pay $90,000 for their new property, they will pay tax on the $10,000 buy down. The second thing you have to do is reinvest all of the cash from the sale of the old property into the new property. If there was $40,000 of debt and closing costs when Fred and Sue sold their purple duplex, and their intermediary received the balance of $60,000, they must reinvest all of the $60,000 in the new property in order to avoid paying tax. This is true even if they put $5,000 of their own cash into the original purchase of the duplex. If Fred and Sue are buying their new property for $150,000, they do not have an equal or up problem, since they sold for $100,000 and are buying for $150,000. However, if they get a new loan for $100,000, which means that they only need $50,000 of the $60,000 that the intermediary is holding, they will pay tax on the leftover $10,000 because they did not reinvest all of the cash. And, as stated above, the entire $10,000 would be taxable. One thing that Fred and Sue could do to avoid this problem would be to reduce their loan to $90,000 so that they use the entire balance of $60,000 held by the intermediary. Thanks to Gary Gorman for that clear discussion. Now let's put it to use.